Welcome to the Manufacturing Money Room with host Tolani Lawson. Tolani is an experienced CFO who works with manufacturing businesses to bring clarity to their numbers, especially when cash feels tight and decisions feel heavy. These are the conversations that usually stay behind closed doors. Until now, it's time to step into the Manufacturing Money Room.
Welcome back. Let me start with a situation that creates a lot of frustration for manufacturing leaders. The business is profitable, orders are strong, margins look reasonable, the P&L says that things are working, and yet cash feels tight. There's pressure on the bank account, there's hesitation around investment, and there is a constant sense that liquidity is just a little more constrained than it should be. So the question becomes, if we're profitable, where is the cash going? In many cases, the answer is not complicated. It's sitting inside the business in inventory. Today, we're going to look at how inventory and purchasing quietly absorbs your cash and why this tends to accelerate as a business grows. Let's start with a simple but important distinction. Profit and cash are not the same thing. I find myself saying this several times over and over again. Profit is an accounting outcome and cash is a timing reality. You can record revenue today, but not receive that cash for another 30, 60, or 90 days. You can purchase materials today, but not convert them into revenue for weeks or for months. And in between those 2 points, cash is tied up. Here is a simple way to think about it. Imagine you're filling a bathtub with water, right? Water is flowing in from the tap. That's revenue. But water is also sitting in the pipes, the tub, and the system before it drains. That's your working capital. If more water gets trapped in the system, the level in the tub doesn't rise the way you expect. That's exactly what happens with inventory. Inventory rarely becomes a problem overnight. It builds gradually. And often it builds for very rational reasons. And these are reasons that I hear over and over again. You're increasing your stock level because you want to avoid stockouts. So you buy in larger quantities to secure better pricing. There is a minimum order quantity, or the higher you buy in bulk, the better discounts you get. So you carry extra material just in case. Your buffer starts to grow. You're creating a buffer against supplier uncertainty in some cases where you don't know if your supplier is going to stock out, so you're just going to buy more. Every decision on its own, at the time you're making those decisions, makes sense. But collectively, your inventory begins to grow faster than the business. I have a client, for example, when I picked up this client, they had inventory on hand that had not been touched in years. Half of their inventory, 50% of their inventory, had not been used or sold in more than 12 months. These type of situations create issues where inventory growth is outpacing your revenue growth. More cash is committed just to sustain the same level of operations. And because inventory sits on the balance sheets, you don't see it. It's not on a P&L and you're not having those conversations. It doesn't always get the same level of attention as profits or other types of expenses. Let me give you a way to visualize this. Imagine your warehouse has a parking lot for cash. Every pallet, every rack, every bin, that's cash sitting still. Some of it is moving quickly, coming in, going out, generating revenue, but some of it has been sitting there for weeks, for months, and in some cases, maybe even years. Here is a challenge. From an operational perspective, it can feel like security. We have what we need. But from a financial perspective, it is idle capital. You could as well park cash underneath your mattress, for example. And as that parking lot fills up, you don't necessarily notice it day to day until you need cash. And suddenly, you realize a significant portion of it is already committed. Now, let's connect this to purchasing decisions. When inventory increases, it changes how purchasing behaves. You start managing based on availability instead of flow. You reorder based on comfort level rather than consumption. You prioritize not running out over efficient use of cash. And this creates a feedback loop. More inventory, more complexity, less visibility, more buffer, more inventory. And once that loop is in place, it becomes self-reinforcing because reducing inventory feels risky even when it's necessary. This creates a visibility problem. Just like pricing and labor, there is a visibility challenge here. Most businesses know that their total inventory value is important and they know what it is, but fewer understand how much of it is actively turning. This is what you refer to as your inventory turn. How many times are you going through and selling that inventory through the year? Are you turning your inventory over at least twice, 3 times, 4 times, or 5 times? I'd expect for a manufacturing business that you are turning your inventory 4 to 5 times a year. How much of your inventory is slow moving and how much is effectively obsolete? So the conversion becomes we have X million in inventory, but the more important question is how much of that is actually working for us? Because inventory that doesn't move is not an asset in practice, it's a constraint. Let's talk about what good looks like. Strong inventory management is not about minimizing inventory at all cost. It's about the flow. So material comes in, moves through the system and converts into revenue efficiently. That's what we want, instead of it just sitting out there, waiting and accumulating. It also means purchasing decisions are aligned with actual demand, real consumption, clear visibility, and not just instinct and not just caution. Because there has to be a balance. Too little inventory will create disruption, and too much inventory creates constraints. So strong businesses need to manage that balance intentionally. What is a practical starting point? If you want to understand whether inventory is constraining your cash, start with a few simple questions. Look at your inventory today and ask, what percentage of these has not moved in the last 60 to 90 days? Then ask, if we stopped buying today, how long could we continue to operate? And then, where are we holding inventory just in case, rather than because it's truly required? These questions are not about precision, they're about visibility, because once you see it clearly, you can start making better decisions. If you're using a manufacturing profit leak diagnostic, you need to turn to the inventory and purchasing section to walk through areas like inventory growth relative to your revenue, your purchasing patterns, stock movements and aging, and then how cash is getting tied up in working capital. Again, you're not looking for perfect answers. You're looking for signals. Where is inventory expanding quietly? And where is purchasing driven by habit rather than the data? You want to see where cash is sitting longer than it should, because that is where this leak begins. Inventory is one of those misunderstood areas of financial performance because operationally it feels like strength to carry inventory, but financially it can be a source of constraint. And as businesses grow, this tension becomes more pronounced because more revenue requires more capital. And without discipline, that working capital expands faster than expected. But even if you address pricing, improve operational efficiency, and bring inventory under control, there's still one more place where profit quietly slips away. And this is not in how you price or how you execute. It's not in how you manage cash, but it's in what you choose to take on in the first place. In the next episode, we will look at complexity creep, where more products, more variations, and more exceptions quietly multiply across the entire business, increasing your cost in magnitude. So before you go, take a moment and look at your inventory, not just as stock, but as cash just sitting out there being inefficient. Because how you manage it determines how much financial flexibility you have. I will see you in the next episode. And if you would like us to help you analyze your inventory and what is sitting idle, reach us on our website, www.fiscal12.com, fiscal12.com, and book a call with us. We'll walk you through that first 30 minutes at no cost to you. See you in the next episode.
Thanks for spending time in the Manufacturing Money Room. If this episode gave you something to think about, let us know. Drop Tolani a voice note or leave a comment or a review. And hey, if you like what you heard, share it with your friends. If you didn't like what you heard, share it with your enemies. You'll find the links in the show notes to connect with Tolani, and if you want to watch the episode on YouTube, that's there as well. Join us next time in the Manufacturing Money Room, where it's all about better numbers, better decisions, better manufacturing.